Welcome back to the channel. Before we get into today's video, I want you to think about something for just a second. Imagine you walk into a store and the price tag on the shelf says the item just got cheaper. But then you look around and notice the shelves are almost empty. Other customers are grabbing everything they can find, and behind the counter you hear the store manager quietly placing a massive order for more inventory. Now here's the question. Do you trust the price tag? Or do you trust what you're seeing with your own eyes? That's essentially the situation playing out right now in the global silver market. And most everyday investors in the United States have absolutely no idea it's happening. The price of silver, particularly on Western paper markets, has seen a sharp drop recently. And if you just glanced at a chart, you might think, okay, silver is falling out of favor, demand is weak, nothing interesting here. But when you dig even one layer deeper, you find something that tells a completely different story. Physical silver demand, real, tangible metal being bought, shipped, and held, is surging in the East, particularly out of China. And the gap between what paper markets are saying and what physical buyers are actually doing is becoming very hard to ignore. That's what we're going to talk about today. Not predictions, not hype, just a clear, honest look at what this divergence is, why it exists, what it has historically meant, and why it might matter to you as someone who pays attention to where the financial world is heading. Let's break this down carefully. To understand what's happening, you first need to understand that silver actually trades in two very different worlds simultaneously. There's the paper market, which is dominated by futures contracts traded on exchanges like the COMEX in New York. In that world, traders are buying and selling contracts that represent silver, but the overwhelming majority of those contracts never result in anyone actually taking delivery of physical metal. It's a financial instrument, a bet, a hedge, a tool. And the price that gets reported on financial news websites, on apps, on TV tickers, that price mostly reflects what's happening in this paper world. Then there's the physical market. That's where actual silver bars, coins, and industrial quantities of real metal change hands. Refineries, manufacturers, governments, sovereign wealth funds, central banks, investors who actually want to hold the metal itself. This market has its own dynamics, its own supply chains, and its own pricing signals. And right now, those two worlds are giving investors very different messages at the exact same time. Here's what this means in practice. When paper prices fall sharply, which is exactly what happened recently, most people naturally assume that means silver is less desired globally. But that assumption breaks down the moment you look at what's happening in Shanghai. The Shanghai Futures Exchange, which is China's primary metals trading hub, has been showing something called a premium. A premium means that buyers in Shanghai are willing to pay more for silver than the international benchmark price would suggest. Not a tiny difference, a meaningful one. And that kind of premium doesn't appear when demand is weak. It appears when physical supply is tight and buyers are competing for available metal. Now this is important because China is not a small player in the silver market. China is the world's largest consumer of silver for industrial purposes, solar panels, electric vehicles, semiconductors. All of these industries rely heavily on silver, and China is manufacturing all of them at enormous scale. When Chinese buyers are paying a premium on top of already available market prices, it tells you something real about where demand actually stands versus what the price tag on the shelf is suggesting. So why would paper prices fall at the same time physical demand in China is rising? That's the core mystery here, and it's worth understanding carefully because it has some important implications. Think about it this way. The paper-silver market in the West is heavily influenced by macro factors that have nothing to do with whether anyone actually needs silver today. Interest rate expectations, dollar strength, sentiment about the economy, algorithmic trading, short-term speculation, all of these things move paper prices. When the dollar is strong, commodities priced in dollars tend to fall. When traders are risk-averse, they sell futures positions across the board. When hedge funds need to raise cash quickly, they liquidate commodity positions. None of that has anything to do with whether a solar panel factory in Guangdong actually needs silver this week. But it absolutely moves the number you see on your screen. So what you're left with is a situation where Western financial markets are repricing silver based on macro financial signals, while Eastern physical buyers are responding to an entirely different set of realities: industrial demand, domestic economic priorities, and long-term strategic needs. And when those two things go in opposite directions at the same time, That's what market analysts call a divergence. It's not guaranteed to mean anything specific, but historically, divergences like this have been worth paying attention to. Let me give you some context about why China's silver imports have been getting more attention from market watchers in 2025 and into 2026. China's solar energy build-out has been extraordinary by any standard. The country has been installing solar capacity at a pace that has repeatedly broken its own records. Silver is a critical component in photovoltaic solar cells. It's used as a conductor that allows the cells to efficiently convert sunlight into electricity, and there's currently no cheap substitute that performs as well. Every solar panel installed in China requires a measurable amount of silver. Multiply that by millions of panels, and you get a demand story that runs completely parallel to, and often disconnects from, what's happening in Western financial markets. Beyond solar, China's electric vehicle production has scaled dramatically. Silver is used in EV charging infrastructure, in onboard electronics, in sensors and circuit components. And China's semiconductor ambitions, accelerated significantly by Western export restrictions on advanced chips, have driven enormous investment in domestic chip manufacturing, which is itself a significant consumer of silver in various plating and bonding applications. All of these trends point in the same direction. The underlying industrial case for silver in China is not weakening, it's arguably getting stronger. And now let's talk about what the Shanghai premium specifically tells us. When you look at a commodity market, premiums and discounts to benchmark prices are signals about local supply and demand conditions. A discount usually means local supply is plentiful, buyers have options, and can negotiate prices below the international benchmark. A premium means the opposite. Local supply is tighter than the benchmark price would suggest, and buyers have to bid up to secure what they need. In Shanghai, meaningful silver premiums indicate that despite whatever is happening in New York on the futures exchange, physical silver in China is not sitting around in abundance, waiting to be bought cheaply. Real buyers are competing for real metal. Now here's where this gets a little more complex and interesting at the same time. The silver market globally operates with a structural supply challenge that doesn't get nearly enough attention from mainstream financial media. The majority of silver produced each year doesn't come from primary silver mines, it comes as a byproduct of mining for other metals. Copper, zinc, lead, and gold mining operations all produce silver as a secondary output. That means silver supply doesn't respond quickly to silver prices the way you might expect. If silver prices rise, dedicated silver miners can ramp up production, but the byproduct silver from copper and zinc mines responds to copper and zinc prices, not silver prices. Supply is relatively inelastic in the short to medium term. At the same time, demand has been broadening. Silver is no longer just a monetary metal or a jewelry material. It has become genuinely critical to the energy transition. You cannot build the solar panels the world is planning to build without silver. You cannot electrify transportation at the scale being discussed without silver's conductivity playing a role. And unlike some other materials where substitution is possible with enough research and investment, silver's combination of electrical conductivity, thermal conductivity, and reflectivity makes it very difficult to replace in many of its most important applications. Some research is being done on reducing silver content per unit in solar cells, and that matters for the demand equation. But it doesn't eliminate the demand, it just moderates the rate of growth. So when you combine structurally limited supply with growing industrial demand from one of the world's largest manufacturing economies, and then you add in the signal of rising physical premiums in the world's most important silver consumption market, and then you observe that Western paper prices have simultaneously dropped sharply, you have a genuinely interesting analytical situation. Not a crisis, not a conspiracy, just a real signal that careful observers of the market are noting. By the way, if this kind of careful, honest look at financial markets and economic signals is something you find valuable, please take a second and hit the like button on this video. It genuinely helps the channel reach more people who care about understanding these topics properly. And if you're not subscribed yet, now's a great time. We put out regular content designed to help everyday investors think more clearly about what's happening in markets. Now let's address the other side of this conversation fairly, because intellectual honesty requires it. Not everyone who looks at this data reaches the same conclusion, and that's completely reasonable. Some analysts would say that the falling paper price is the more reliable signal, and that physical premiums in specific regional markets can persist for localized reasons that don't reflect a global supply crisis. They'd point out that silver has had sharp price drops before and recovered based on broad macroeconomic conditions, not specifically because of Chinese industrial demand. They'd also note that Chinese import data can lag real-time conditions, and that strategic stockpiling decisions by Chinese entities don't always translate neatly into future price movements. There's also the argument that Western paper markets are far more liquid and involve far more sophisticated participants with access to global information, so the price they set, even if driven by financial factors, may still reflect something meaningful about the metal's prospects. These are valid points. They deserve to be acknowledged. The world is complex, and single variable narratives in financial markets almost always oversimplify. What we can say with reasonable confidence, though, is that the divergence itself is real and measurable. Shanghai premiums are a factual market signal, not an interpretation. Chinese silver import volumes have been documented and reported. The industrial demand case from solar and EVs is supported by production data. These aren't disputed facts. They're data points that different analysts weigh differently when drawing conclusions. The more useful question, rather than trying to predict exactly what happens next, is this: what does this situation tell us about the framework through which we should be thinking about silver in 2026 and beyond? Here's a simple mental model that might help. Think of silver as operating across three distinct demand categories that each move at different speeds and respond to different signals. The first category is financial demand. Investors buying silver futures, ETFs, and similar instruments as a hedge against inflation, dollar weakness, or systemic risk. This category is very sensitive to interest rates, macroeconomic sentiment, and Western monetary policy. When the Federal Reserve is expected to keep rates higher for longer, this category tends to pull back, and paper prices reflect that. The second category is investment-grade physical demand. Coins, bars, allocated accounts. This category tends to respond to financial demand signals as well, but with a twist. When prices drop sharply, retail and semi-institutional buyers often see that as an opportunity. Price drops can actually accelerate physical buying in this category, which is the opposite of what happens in paper markets. This counterintuitive behavior is one reason physical premiums sometimes rise even as paper prices fall. The third category is industrial demand, and this is the one that's most relevant to the China story. Industrial demand is driven by manufacturing plans, energy policy, and long-term infrastructure build-out. It's far less sensitive to short-term price swings. A solar panel manufacturer in China has contracts to fulfill. A semiconductor fab has production targets. They need the silver they need at whatever the market price is, because stopping production costs far more than paying a modest premium for silver. This category of demand is stickier, harder to compress, and growing in structural importance as the global economy electrifies. When you understand those three categories, the current situation makes a lot more sense. Western financial markets are repricing the first category downward due to macro conditions. But the third category, Chinese industrial demand, is operating on its own timeline and not really responding to what happens on COMEX. The gap between those two signals is the divergence we've been talking about. And historically, when financial pricing and physical fundamentals diverge significantly, one of two things eventually happens. Either the fundamentals weaken to match the financial signal, or the financial price eventually moves to reflect the fundamentals. Neither outcome is guaranteed in the short term, and timing is always uncertain, but the divergence itself creates an analytical tension that's worth tracking. Let's also zoom out for a moment and think about what this means for the broader global conversation about commodities and economic power. One of the understated stories of the last several years is the increasing divergence between how Western financial markets price commodities and how Eastern physical markets consume them. We've seen this pattern in oil, in copper, and now arguably in silver. Western financial instruments set prices that respond to Western macro signals, but the physical consumption of those commodities is increasingly driven by Asian industrial and economic priorities.
That's not a conspiracy. It's just the economic reality of where manufacturing, infrastructure build-out, and industrial growth are concentrated right now.
For everyday American investors, this matters because the price you see on a silver ETF or a futures-based product reflects Western financial market dynamics. It may not fully reflect the physical demand story playing out thousands of miles away. That's not to say Western prices are wrong. Markets are complex and incorporate many factors simultaneously. But it does mean that reading just one metric without context can give you an incomplete picture. Now let's think about what this means practically. for someone watching this video who might hold silver or is thinking about it. First and most importantly, none of this is financial advice. Everyone's situation is different, risk tolerance varies, and investment decisions should be made carefully and, when significant, with the help of a qualified professional who knows your specific circumstances. What we can do is think through the considerations clearly. The sharp price drop creates what many value-oriented investors call opportunity tension, a situation where the headline number has moved significantly enough that it forces a reassessment. Is the lower price reflecting a genuinely deteriorating fundamental outlook, or is it a financial market repricing that has temporarily disconnected from physical realities? That's the analytical question. And the signals we've been discussing, rising Shanghai premiums, strong Chinese import volumes, continued industrial demand growth, suggest the latter is at least plausible. But plausible is not certain, and markets can stay disconnected from fundamentals for longer than anyone expects. What the Shanghai premium signal specifically tells an attentive observer is that the most sophisticated and scale-sensitive physical buyers in the world, Chinese industrial consumers, are not behaving as if they believe silver's future is dim. They're paying above benchmark prices to secure supply. That's a bullish physical signal, full stop. Whether it translates into Western paper price recovery and on what timeline is a different and harder question. One thing worth noting is the historical pattern of commodity market divergences resolving. When paper prices fall sharply while physical premiums rise, it often attracts a specific type of market participant, the arbitrageur. These are traders who recognize the pricing gap and attempt to profit from it by buying metal where it's cheap, in paper form or in Western markets, and selling where it's commanding a premium. This arbitrage activity, when it occurs at sufficient scale, tends to narrow the gap over time. It's not a precise mechanism with predictable timing, but it is a natural market force that works to resolve divergences. The silver market has a history of periodic sharp price movements that, in retrospect, look like volatility within a longer structural trend. Silver famously had dramatic swings in the 1970s and 2011, and at various points in between. In each case, the narrative at the moment of sharp price drops focused on weakness, lack of demand, or macro headwinds. And in each case, the underlying physical market told a more nuanced story. That's not to say prices always recovered immediately. They often didn't. But over time, physical fundamentals tended to matter. The situation today has some genuinely novel elements that previous silver cycles didn't have. The scale of China's solar energy build-out is historically unprecedented. The electrification of transportation is a global megatrend with decades of runway, and the geopolitical fragmentation of global supply chains means that strategic stockpiling of industrial inputs, including silver, has become a more deliberate economic priority for several major nations. These structural elements create a backdrop for silver's industrial story that's arguably more powerful than in previous cycles. Whether that translates into higher prices depends on many factors, including supply responses, substitution research, and global economic health. But the foundation of the demand story is real. So what should you actually take away from all of this? A few things worth holding in your mind as a thoughtful observer of markets. The first takeaway is that price and value can diverge, sometimes significantly, especially in commodities where paper financial markets and physical industrial markets operate on different logic. When you see a sharp price drop in a commodity, it's worth asking, is this a physical demand story or a financial market story? In silver's case right now, there's strong evidence the recent drop is primarily a financial market story, while physical demand signals remain robust. The second takeaway is that geography matters more than ever in commodity markets, where consumption is growing, what buyers in those regions are paying, and how supply chains are evolving. These regional dynamics can tell you things that a single global price benchmark doesn't. The Shanghai premium is exactly this kind of regional signal, and it's one worth following over time. The third takeaway is that industrial demand in the energy transition is becoming a more structurally important driver of silver than many traditional silver market frameworks account for. Silver is not just a monetary metal or a speculative asset anymore. It is an industrial material with no cheap substitute in some of its most important applications. That changes the risk and opportunity profile in ways that deserve more attention. And the fourth takeaway, and perhaps the most important one for everyday investors, is that incomplete information leads to incomplete conclusions. If you only look at paper prices, you're only seeing part of the picture. If you only read Western financial media coverage of silver, you're only getting one perspective on a market that is genuinely global and genuinely complex. Adding even a little more context, like checking physical premiums, following import data, understanding industrial demand trends, can make you a more informed and thoughtful investor, regardless of what specific positions you hold or decisions you make. As we head toward the back half of 2026, there are a few things to watch that could help clarify which direction this divergence resolves. Watch the Shanghai premium. If it widens further, it strengthens the physical demand thesis. If it narrows sharply, it may indicate that supply has caught up or demand has moderated. Watch Chinese silver import data as it gets reported quarterly. Significant continued import volumes would support the bullish physical narrative. Watch Western macro conditions. If interest rate expectations shift in a way that weakens the dollar, that could provide a tailwind for paper silver prices to begin aligning with the physical signals. And watch industrial policy developments, particularly around solar installation targets in China, Europe, and the United States. These have direct implications for silver's industrial demand runway. None of these signals will give you a perfect prediction. Markets never offer perfect predictions, but they'll give you a richer picture. And a richer picture leads to better thinking. That's really the goal here, not to tell you what to do, but to help you think more clearly about what's actually happening. The hidden silver signal that mainstream investors are missing isn't a secret. It's not a conspiracy. It's not a prediction. It's simply a divergence between two different ways of measuring the same market, and a recognition that the physical demand story coming out of the East tells a meaningfully different story than the paper price story playing out in Western financial markets. Whether that divergence matters to you depends on your own perspective, your own portfolio, and your own view of how the energy transition plays out over the next decade. But it's a signal worth understanding. And now you do. Thanks so much for spending this time with me today on the channel. If you got value out of this breakdown, please leave a like. It genuinely helps more people find content like this. Drop a comment below with your thoughts. Are you watching the silver market? Are you paying attention to physical premiums? Have you been following what's happening with Chinese demand? I'd genuinely love to hear how you're thinking about it. And if you haven't subscribed yet, hit that button so you don't miss the next video. We're going to keep digging into these kinds of market dynamics and trying to make sense of them together. As always, stay curious, stay informed, and I'll see you in the next one.